My name is Arthur Mrozowski, and I'm running a Silicon Hill Venture little boutique shop in the Bay Area in San Francisco. And we'll be talking today about the future and outlook of the cryptocurrency. And I'd like to, introduce the panel today to all of you guys. And first, I'd like to introduce Carlos Nieto, Managing Director of Ineo Strategic Growth Advisory. And I would let him talk about his firm and introduce himself, and then we'll go and take the role with the other fellows from the panel.
Thank you, Arthur. Yeah, my name is Carlos Nieto. I run a private direct investment family office practice. And just to share with you guys a little bit about my background. I started as an entrepreneur in the 90s, growing in the energy, environmental services, and renewable space till the 2000s. Then graduated that stage, built 6 companies and sold 3 of them successfully. Then went to business school and ended up in Wall Street for a little bit, around 15 years, doing a career in Deutsche Bank, Lehman Brothers, and ultimately in Barclays. And then I left the firm to start this practice, and I've been advising families investing in doing direct investments in different spaces. I've gone anywhere from financials, fintech, environmental services, recycling, oil and gas, and consumer products. Consumer products going with digital marketing, doing roll-ups in digital marketing. And that's how I ended up in the blockchain space, that now I'm currently advising a fintech company that is able to provide all sorts of fintech innovation into any size bank by doing an API integration with only one integration. A bank can access endless number of financial solutions. The other company in the space that we're working on right now is a company that is securitizing commercial real estate through securitized tokens. And the third one that is a project that we've been doing a lot of research on is taking a lottery to the metaverse. So a real lottery license, and merging it into the metaverse to have, basically the thesis there is to sell a local license, have access to the lotto around the world, and be able to gamify the whole concept of lottery within the metaverse. So that's great. A little bit about my background.
Sounds great. Well, thank you so much, Carlos. And let me introduce you to Steven Ruttenberg. He's the partner of the company that is hosting you guys, Polsinelli. And let him introduce himself.
Hi everyone. Sorry I couldn't be there in person today. You're getting the better views, and I'm sure you've heard a bit about Polsinelli already, and you'll probably be hearing more. But myself and Dan McAvoy, who's co-head our crypto fintech efforts, which is, we can probably have about 40 lawyers in the firm, which are somewhat touching the space, everything from tokenizing real estate to advising healthcare companies that are interested in using the blockchain for data privacy or data security, to charities who want to accept crypto, to projects in the metaverse, to NFTs, to a number of level 1 blockchains. And we really provide, I believe, the best of both worlds, in which we have dedicated expertise, but we're also in a 900 lawyer firm that can really handle everything that comes up, even if it's just a family office or someone who's shown a crypto opportunity. It was like, does this make sense to us? We've probably seen it or something like it, or know someone else in the space. So as you'll hear more, this is a very dynamic space where what was hot 6 months ago is now probably also hot, but together with something else new. And it's just a fascinating time to be here and be trying to hold on as this is moving very quickly.
Well, thank you very much, Steven. And then we have Abi Subramanian. Is that properly pronounce the name? Okay, thank you. Thank you, Abi. And so Abi comes to us also remote, and he's a managing partner of GGA Private Capital. And I let Abi to introduce himself.
Yeah. So I'm actually coming in sort of as a representative of a single family office out of Asia called BlackPine. And they are almost exclusively sort of crypto native. It's about, about a 10-year-old firm, and I'm their sort of US representative. And so primarily invest in sort of future facing industries, of which crypto is probably the big component. And within crypto, I've been investing probably since 2011, 2012 across the spectrum in tokens, now pretty broadly diversified in terms of investing in different areas from DeFi to NFT, gaming, Web3, infrastructure, et cetera. So look forward to joining the panel, and for which I'm sure will be a very spirited discussion.
All right. Well, let's start it. I think that let's start from Carlos. You seem to have a very international connections, and then probably a good outlook on international aspect of the cryptocurrencies around the world. Can you like tell us what's going on in countries outside of the US about the adoption and regulations?
Sure. Well, regulations. It's a different topic, but adoption. I think that is something interesting to see how the market has grown. I mean, from 2018 to 2020, the adoption grew at like almost 200%. Countries that led that adoption were India, South Korea, the United States. Leading with growth from 2018 to 2020 of anywhere between from 7% to 18% of the population, around there, most of them. And the other thing that helped the adoption in those countries was that the ATMs, and it's amazing the difference between the coin ATMs that are available for instance, in the US is more than 20,000 spots. Then the next biggest one is Canada with 2,000, and Europe around 2,000 as well. And then the rest of the world, all countries have around less than 300. So that helped a lot the adoption. And when I first heard of these ATMs, it's amazing that even though with all the regulation that we have here, the country is allowing for people to go into a fueling station and convert their dollars into crypto. So I guess that's one of the things that made the adoption bigger. The rest of the world, like you have places like Brazil that have been growing as well, not at the same pace, but in our case, we've seen the growth in Latin America go as well from year to year in the double-digit growth in the adoption of the cryptos.
Sounds great. Stephen, question for you. How is the current adoption in the regulations here in the United States? I've heard that the Security Exchange Commission is trying to come up with their own version of pretty much ability to sell the crypto on their own umbrellas, and Jeremy Powell said they have no intention of banning the cryptocurrency. So that's fantastic. But where are we right now with all those processes?
It's a very good question, and dealing with regulation in this space is both complicated and frustrating. But a lot of it really depends what you're looking to do in this space, and I think you have to categorize what you're looking to do and where that is on the spectrum. Meaning, for example, there are a lot of ways to invest in this space that don't necessarily involve the SEC or involve the SEC in a way that is fairly compliant. I mean, for example, on one extreme, buying a I think Abi will probably have what to add on this, buying a share of Coinbase or something like that. I mean, Bitcoin itself and purchase and sale of Bitcoin for your own use or as an investment is pretty much in the clear. I mean, the SEC, it is truly the decentralized network more than anything else. The SEC has made it clear that they do not consider it to be a security. There was no security sale for Bitcoin. Ethereum also is in the safe zone. And while the taxation could be complicated, if you're dealing with Bitcoin on a state level for money transmission or buying and selling it as a business, there's a number of regulations you have to comply with because it is treated for money as that. But in terms of that, that's not an area that we really worry about the SEC getting particularly involved in. There's also, from a legal perspective, kind of on the other end of the spectrum, if one wants to use a crypto as a digital representation as a security, that will fall under the securities laws, whether it's real estate, as Carlos was mentioning, or something else. That also will fit under the securities laws and kind of makes sense. That market has been very slow to adopt, mostly due to logistical issues with the market. We're in a really difficult place in the United States. Our people are trying to issue their own level 1 blockchain. And for those not familiar with that, that's kind of to replace Bitcoin and Ethereum with another one. And there's probably about 10 other ones out there. And many of them want to issue a token to be used on that network. And that is something that is really difficult in the United States because the SEC has provided basically no guidance. And the SEC really believes that they're all securities, yet they don't really work as securities. So we're kind of, for new issuances of tokens that want to act as a currency or want to act as a word that we don't really have a legal purpose for in the US of a utility, there really isn't a way to do that. And most of the projects we're working on are working on offshore or are working in some sort of gray zone to try to somewhat comply with the securities laws. And that is unfortunate because, as Carlos mentioned, the US is still a really important market, and we have to work that out. But it's important to know that that's just one segment of the market. There are plenty of other segments that people are investing in and are really exciting that are not subject to that.
So in other words, only the issuance of the new quote unquote tokens is in a kind of an unknown state right now.
Issuance as well as trading, and that could be, though the SEC hasn't technically any fractionalized interest of something is probably considered to be a security. So, for example, if you have a painting and an NFT or a digital representation of a painting, that's not considered a security. But if it's a fractionalized interest of a painting, that probably has to comply with the securities laws. And the trading of that will have to comply with the securities laws. That doesn't mean there isn't gray zones there. There aren't exemptions. There aren't ways to get around that. But yes, that's really where, and anything that offers a profit, any token that offers a profit interest is probably would be considered a security as well. I mean, so, which is getting where people are moving in the NFT space and where we're providing a lot of advice and trying to pull our hair out about that.
Well, thanks, Stephen. Abi, question for you. You've been on the forefront of new trend, which is Web 3.0. That it's going to be a total game changer. Can you tell us about why that is?
Yeah. So I think the best way to describe it is, in the 90s, we had Web 1.0, which is kind of, read whatever is shown to you on the web, right? And Web 2.0 was write, i.e. comment back to the web ecosystem. So Web 3.0 is basically read, write, and own. So what it basically is a fully distributed, decentralized way to own your identity and to be able to monetize your identity and your network on the web. So in Web 3.0, for example, if you're a member of, say, Snapchat or Facebook or Twitter, your ecosystem is yours. So today, when I post a picture on Facebook or Instagram, that platform essentially owns the content. And when I leave, I sort of lose the access to the information. Whereas in Web 3, this will sort of be portable with you, basically. Similarly, in Web 2.0, if you put up a picture on Facebook or whatever, the platform makes sort of 99% of the profits mainly through an ad-supported model. In Web 3, it allows for the creators to really monetize themselves using the ecosystem. So basically, you can sell things through the internet, and you can be paid for it. You can, if you put up a short form video and somebody can, buy and sell it, somebody can tip you, you can sell, commerce services through Web 3.0. So it's the first sort of distributed platform that allows for full monetization and the creator to control sort of his or her persona in the web. So it's going to be quite material and meaningful to the web, just like Web 2.0 and Web 1.0 was starting in the late 90s, carrying on to today.
Well, the part of this Web 3.0 is the concept of the NFT, and NFT is something that I'm really struggling to understand. Can you perhaps explain to me what that is?
So for example, if you take cash, right? Let's just say use a US dollar. If I give you a dollar and I want it back, you can give me a dollar that you get from somebody else, right? So it's totally fungible. $1 is equivalent to the other dollar, and it doesn't matter which dollar you give me back, right? NFT means non-fungible, i.e. each NFT has its own unique property. So for example, if I have an NFT of myself or some property of my value providing on Web3, it's specific and particular to me. And so your persona, your identity, your tag, whatever is specific and personal to you. Mine is personal to me. If someone else creates it, it's personal to them. So the non-fungibility means non-transferable, right? So
yeah, let me just add something on that when you're finished. Maybe it'll make that a little bit clearer. So, when we talk about an NFT, it's technically means a non-fungible token, and that, for example, it could be a piece of a right to a stock or a security or something like that. But there's a scale of what you consider of how non-fungible it is. Meaning, for example, let's say we take an apartment building and we sell tokens instead of shares in that building. That'll be a non-fungible token. But if there's 1,000 shares or 1,000 tokens issued related to that apartment, those will be fungible in and of themselves. But if I have an identity token, which would represent me and would be used to kind of as a digital representation of my identity, that would be completely non-fungible because there's just one for one. So many times when people talk about a token not being fungible, and a token, you could just think of it as being a digital representation of something. In some ways, it's not that different than a share or a depository receipt. There's a scale of how non-fungible it is.
But let's keep it simple, right? It is non-fungible in its atomic level. So for example, if I create a photograph, an NFT, that photograph is unique, right? There's only one of it that exists. And if you create a photograph that's just totally different, if you and I create a photograph of the same object in Web3, mine has unique digital identity and yours is a unique digital identity. So basically what it allows for is in the artistic world, let's just say today, if you create a song, right? Or let's just say you create a piece of art, you make the primary art, you sell it to a dealer, you get paid $100, right? And so the dealer can sell it as the next Picasso for $10 million to the next person, but you, the artist, won't see any provenance, you won't see any profit give back to yourself. Using an NFT, when you create the piece of art or the picture, there's always a digital connection to you. So when you sell it to somebody and they sell it to somebody and so on and so forth, you will always be able to make a profit and given that you were the original creator. So given that uniqueness that the NFT provides, there's always a link to the original creator. So that's what makes it a non-fungible piece of asset, be it art, picture.
Abi, if I may add to that, just to clarify, you would have to write that into the NFT. So all the commission structure, all the pricing that you would have, that's why it makes it unique. So, and that's why you get the the provenance or the traceability, and that's how the artist can get paid back.
And then can I have you guys take this just one level further in that concept of the smart contract you just described?
Yeah.
Right. So you have this royalty that you can tag along with, right? Which is great for the simple artist and a painting.
Yeah.
But maybe you guys could expand on a little bit of the other applications that you think are going to become primary. Say, oh, Chet, well, here's 10 of them, or here's the next top 3 that really make a lot of sense, where you can put a smart contract in. Art's a real simple one, and but I suppose there's probably a pretty dynamic set of use cases coming up. I'd love to hear what you guys see.
I'm going to start with the layman's definition that I have to myself to explain myself on how it works and then how you can apply it. And then I'll defer to Steve to go take a deep dive on the legal aspect of it. But I see a smart contract as a trust that never dies. And then you can write up the contract however you want to write it up. I mean, I've seen them for eolic park. I've seen them for solar power parks. I've seen them for real estate. I've seen them for art. And now we're writing one for a lottery. I mean, so you could put anything into that contract. The beauty of the smart contract is that once it's uploaded and is followed, if it's completely decentralized, it can be managed by the system. And that's where the challenge is. The decentralization of a smart contract or the smart contract that is backed by a security in the case of the security-backed tokens. Securities have to be managed by humans at some point because it's real assets behind them most of the time. One of the contracts like this might carry on for itself, and every time like the art piece moves, somebody will be paid, or maybe 10 people will be paid.
Right.
So that's and I'll defer to you, Steve, to take a deep dive there, or Abi.
Abi, why don't you go first, and then I could be the party.
Yeah, I mean, I think one sort of corollary question is, right, is that obviously you hear about these NFT sales and there's some crazy values for, crypto punks or Bored Apes or whatever, right? So they obviously, we're in a bubble, so on and so forth. Clearly, we're in a bubble, but I think that the category itself is pretty elemental and fundamental to Web3 and a lot of the things we're talking about. So in terms of you're asking sort of future applications, it could be anything, right? For example, our health records could be in the form of an NFT, right? There's a situation where, for example, if you had to make like fair trade coffee, right? An NFT will essentially, in it will be embedded in terms of how this thing was made in the supply chain. So you can sort of audit how it was made, whether it was made according to the way you said it was made. For example, if you make a drug, right? That drug's properties in the manufacturing could be in the form of an NFT. So you know that the proper steps were taken in terms of its manufacture and so on and so forth, so that it's regulatory compliant. So there's many aspects today. It's about art and pixelated figures and things like that. But in the future, it could be health records, it could be manufacturing, it could be all sorts of things that are more broadly relevant to many of us.
Thanks. I mean, I think one of the probably best descriptions of where automated smart contracts on a decentralized network makes sense is a Wharton professor, Kevin Warback, wrote a book about blockchain a few years ago and said people talk about it as being a trustless network, but probably a better way to think about the advantage of the blockchain is you're actually trusting the network instead of the counterparty. Meaning what blockchain lets you do for the first time is to interact directly with parties or with a party that you don't necessarily trust, but instead you're putting the trust in this decentralized network. So for example, something like royalty payments where you may not trust the plant that's producing it, or something else we're working on, carbon trading credits, where you can use this smart contract, though it won't necessarily even be the commercial contract. The smart contract will actually be the method of gauging what's happening from the plant. Because to get onto the health record side, which is another area that I think is really interesting use of blockchain, because contrary to popular opinion, blockchain is not a privacy tool. If anything, blockchain and GDPR are in conflict. Blockchain, not that there aren't ways of dealing with that. Blockchain puts the data everywhere and makes it very hard to change. So for example, healthcare records, where what you're really afraid about is somebody modifying it, putting that on a blockchain where you're afraid of it getting modified downstream is something that is really interesting, as well as any type of contract where you're dealing with a party that you don't necessarily trust. But if you have a network that you trust, suddenly the world becomes open to being able to transact with a lot more people.
So Stephen, I can generate my own non-fungible token, right? And go out and sell it according to this. I'm a valuable person.
Well, I mean, and that's a really good point. And most of the networks and much of what we're seeing is not really decentralized. And decentralization here is somewhat of a dream. If you were to launch your own NFT, well, if you were to launch that on a blockchain representation of yourself on a trusted blockchain, we would have to somehow know that you're not going to sell another NFT of you. But if you were to launch the NFT and then we lock you up in the basement, then that NFT, as long as it's on a trusted network, that would be the only Arthur and NFT. Or if there's one trusted network that will only accept one of you. But as you could even see from that, suddenly the enforcement mechanism and how do you really know it's really decentralized? So at this stage, most of the networks do have some sort of centralization to make sure that there aren't going to be a million Arthur NFTs.
Yeah.
And if you're just issuing it yourself, it's trusted, but it's centralized and related on trust for you. And which is not that different than many of the projects we're working on, where decentralization is a step down the road. So many people are investing in doing very interesting projects that aren't decentralized yet. And the SEC knows that, which is why they consider them to be security.
Getting closer to understand it, maybe another 20 of those sessions and I'll get the clarity. But more difficult it is, the better, the greater the barrier of entry. So, hey, I'm working on it. Quick question for you, Carlos. We're getting to the point where the prediction of the crypto, like the measuring stick is usually the Bitcoin. And analysts were predicting that the Bitcoin was going to be 20 by the end of this year, around 75 grand. Now they're downgrading it to 65,000. I think that there is a relation between any of the cryptos and how the investors are feeling about them in general. So you're seeing that little bit of a correction trend. What are you thinking about the investing in the cryptocurrency? Like what would if you have a cash now, what are you doing with it in the crypto world?
Well, general consensus, and it's my personal investing in crypto is different than what I would advise to anybody else. But what I've been reading is that no more than 10% because of the volatility that the currency represents right now. The correlation with the stock market has been growing. It stays way apart from it, but it has been growing because of the volatility in the markets. So people run to safety, and as interest rates change, that will keep staying in a very similar way. So I don't think that anybody that invests in crypto would be looking at more than that. And we are still at beginning stages. I mean, the fact that we are at the levels that we are and how it's grown, it doesn't mean that they coming in and out. Now, as regulatory aspects of it become stronger, I think that you'll see more institutional investors understand the space. But if you look at and I recently got a chart from CB Insight that says the lay of the land on what the metaverse is. And if you see how they have it laid out by infrastructure, all the levels of protection, infrastructure, connectivity, liquidity, transactability, it's very clearly laid out, and they're very big players, like the top names in the different strong industries participating already. So this is going to lead to a more stable, less volatile investment, let's say, scenario. So more institutional investments will come in, and for the retail investor will be a lot better as well, because it's going to be a lot more information to be able to make decisions.
So,
I think
you've got some investments, right, in NFTs and in crypto in general, and then NFTs.
Yeah, I mean, so just you were asking about crypto. We can just talk about Bitcoin. I think that there's many ways to if you're a family office and you're sort of zero exposure, there's many different ways to get involved, so to speak, right? One is you can invest in the different tokens, BTC, Ethereum, Solana, many of the DeFi protocols, and gaming, etc. So, and then we'll get to that in a second. You can also own public stocks like Coinbase, right? That's a good proxy for the space, meaning the picks and shovels play, meaning whatever happens, that's a protection. You can own a miner, a public miner, a lot of cryptocurrency miners as a way to play the space. You can invest in a Bitwise fund, for example, or an ARCA fund, right? To sort of allow third-party managers or Pantera to run the money for you. But with respect to Bitcoin, I think that there are a lot of, in general, I agree with the sort of the 10% rule. You want to be how you want to be properly allocated. You want to be, because obviously it's quite a volatile asset. You want to be able to sleep at night. But in general, given that 19 million of the 21 million supply has been mined, the general trajectory is up. Right now, there are lots of funds, people coming in and out of the market, so it's a bit choppy. There are different narratives, like there's an inflation narrative. It looks like, at least now the last year, 6 months, the BTC is very heavily correlated to NASDAQ, so it's almost like a proxy for the stock market. So there are a lot of questions, but in general, given by the virtue of the fact that 19 or 18 out of 21 have been already mined, and every incremental one, just basic supply and demand implies that the pressure for will be upward, right? You don't want to get in the business of timing the market. My best advice would be just to pick a comfortable allocation, if you will, and just stay put. Because another statistic is that just like the vast majority of the stock market's gains are over a concentrated period of days, it's even more so in crypto. The movements are very concentrated amongst days in a given year. So you don't want to be in a position where you're trading in and out. You want to be, whatever it is, just stay put, and I think you should be okay.
And Abi, to add to your point, I think a less volatile strategy to invest in crypto is to invest in the crypto infrastructure. As you were saying, like the exchanges, for instance, you have exchanges that can deliver money anywhere in the world these days, and they trade any sort of currency. So they are valued on fundamentals. So it's basically the volume they trade every day. I've seen exchanges like that go from 300 million in daily volume in trade to today in 2 years, $7-8 billion. Like it's just they're going to stay there. I mean, because they are infrastructure play within the space. They don't have the same volatility.
Totally agree that's where a lot of the value is. I mean, it is a bit ironic that the decentralized market that's supposed to get rid of the intermediaries, probably the best play is the intermediaries right now, and that this market has produced a tremendous number of intermediaries, and intermediaries are actually making a lot of money. Bitcoin remains the safest, but there still is always the chance. I mean, we are in the early stages of this industry. I tell people that this is not the late 90s of the internet. This is probably the 80s, where it's not clear even what that HTML is going to be the winner. Every day that Bitcoin is out there, and I'm talking about Bitcoin as an investment, basically as a virtual gold. There are people who see Bitcoin still as a payment system. I think we're still there. I believe there will be a digital payment system. I don't believe it's Bitcoin. That's just me. I think we're still out there and trying to figure out what it's going to be. Is it one of the current level 1 blockchains? Is it going to be something more private? Is it going to be government controlled? Bitcoin, every day that it remains the vast majority of the market, becomes a better chance to be the digital gold. But Bitcoin has 12 years, gold has about 5,000 at least. So Bitcoin is catching up slowly, but as Bitcoin survives crisis after crisis and remains the predominant crypto, that gives it its imprimatur. And also the fact that Bitcoin wasn't illegally sold and isn't a security. You know, I kind of say Bitcoin's a little bit like the Bible. You know, no one knows exactly where it came from. It kind of has this origin mystery, which I think gives it some of its power.
Well, it also uses a lot of
Hey,
power.
Arthur, can I just jump in here 1 second?
Yeah.
Arthur?
Yep.
Yeah, you had a question from the audience in the Q&A. I don't know if you saw it, but before you go to that question, can you guys just talk about the rate of change of the space? I mean, just at a very high level, because I mean, I'll give you a great example. You know, we had Coin Fund present back in 2018. You know, they've done fantastic. Their first fund, they had $1 million in it, converted to 100 million, right? And so, and they had like this diagram of all the opportunities, and then Pantera came along with their diagram. And then I saw another diagram recently just of the crypto opportunity in the metaverse, which is just, you know, pretty large, right? So you talk about the rate of change, because my fascination isn't with Bitcoin increasing in value, but all the other stuff that's being put together in blockchain, you know, et cetera, and how it's being utilized so many other ways. Now, I'm not sure how a lawyer can keep up with it, much less anybody else, right? Because it seems like there's so many applications. Abi, I don't know if you want to talk about that, but.
Yeah, I mean, your question is rate of change, right, Marty? So I think that rate of change that's the hardest part of the space, actually, for anyone that's in it, is sort of keeping abreast of the rate of change, meaning that every month, every 6 months, the level of innovation is like, I mean, it's exponential, even as compared to the tech space, which I'm sort of coming from, right? So, you know, it's literally, in some respects, pretty mind-boggling how much innovation and rate of change happens. So I would argue that really that the investments on the private side into cryptos really has become almost parabolic, starting in probably post-pandemic, right? Kind of late 20 into 21 on the private markets, irrespective of whether the fact that BTC and all these proxies have been choppy. So given that to be the case, I think that for family offices and folks that are just starting to allocate, you know, it may be wiser, if you will, or more time efficient to give it to a third-party manager, because there's so much happening in the venture space, and it's almost like a new galaxy being formed, right? There's so much happening, things are being created, other things are dying off. And so really, you got to track this stuff on almost a daily basis, because it's, you know, the rate of change is almost accelerating like probably nothing else that anyone's seen. So it's quite a bit to get a handle on.
Right. Steve, can you talk about your own experience and how quickly it's changing and the application?
Is that to me?
Yes, yeah. Stephen.
Yeah. I mean, there is not that the old ones go away, but I'd say, for example, a few years ago, it was mostly people wanting to invest in Bitcoin or do fairly simple, we're calling ICOs of token issuances. And that was the market a few years ago, as well as a lot of interest in tokenizing pieces of real estate. And I'd say if you ask somebody 3 years ago what an NFT means, they would say, you know, you buy an apartment building and you have a right to a profit interest on that, similar to what was done with the St. Regis, where 20% of the St. Regis in Aspen was put into a fund and tradable tokens were put behind that, and that's an NFT. The meaning of that word. So there's no, if anyone's confused by the meaning of the word, don't feel bad, because actually what people refer to it actually has changed over the last few years. It still means a piece of a building, but it's gotten much closer to what Abi was talking about as being a representation of a Picasso. And then even more recently, when a lot of people are referring to an NFT, they mean actually something that's fully digital, a piece of art made on a blockchain, made digital, which is sold at auction for a lot of money. And each of those things has its own issues. I mean, what particularly who owns the intellectual property, which is Pete, who's one of our hosts, is an intellectual property lawyer, and that's the space has moved kind of from being tax laws and money transmission laws to being very SEC securities focused to now being very intellectual property focused. I mean, really much of our practice now is lucky to have about 200 intellectual property lawyers at Polsinelli, because the real issues with these NFTs is, are you allowed to use them and do you own it? That's just one example of where the space is going. And I'm sure it's going in more directions where we'll be dealing with increased commodity laws, increased commodity pools for some of these lending platforms that we didn't even get onto.
So last year, $15 billion was raised in venture capital just for the blockchain space, right? So I mean, it's going to be deployed in a big way in the next 5 years. More money we raise. I think Pantera, Andreessen Horowitz, I forgot the other one. They all raised $1 billion plus funds just for this kind of investment. So it's going to be a very interesting space.
And many of those funds some of them are non-token based. Some of those are mostly buying tokens. Many of them are now, which I take as a real maturity of the market, they're really looking to invest in companies that are touching in this space and not tokens. Many of them will take tokens as a bonus. And then there are funds which are investing in tokens. We don't have enough digital assets on a blockchain other than art NFTs to have a fund out of that. But I think we will start seeing that as well.
Can you guys address the whole asset-backed token space? Because I think that's Rosario was going, was kind of trying to discuss that in his Q&A. Okay, so can you address the asset-backed token? And I mean, I know obviously this is application in real estate. To me, when things are tokenized and there's more sort of a crowdfunding aspect to it, values of things go up, right? Because there's different layers of investable capital, right? So you've got the institutional and then you've got retail. And once the retail is allowed into the institutional, all the value of those assets goes up. Maybe you can talk about that, Abi or Carlos?
I want to take a quick plug. So Yield Street actually we have a Pantera early stage token fund that recently closed, and we were accepting investments starting at $25,000 up to $1 million. It's the first time that retail investors got access to this fund. So unfortunately, it closed recently, but we will be offering Pantera again.
That was the $1 billion fund that he just raised?
Yeah, this was, I will get back to you with all the details, but I'm looking right now.
I just got a letter from them, Mike, because I've been an LP in
token fund 1.
Yeah, interesting, right? So can you guys address that?
To me, the most interesting question is, really the connection between a token and the equity side, right? Because over time, in the next 10 years, I think everything's going to be tokenized, right? One would think. But what's interesting to me is a company that basically, has the equity capital stack, right? And has a token stack. And the valuations of one versus the other. And to me, it's all fascinating how they harmonize because, if you have a token raise, you can go public, quote unquote, in 6 to 9 months, right? From the seed investment to the public listing. Whereas if in traditional venture capital or private equity, it takes whatever long time it takes. So to me, the equally fascinating thing that I'm trying to understand intellectually is how you harmonize a capitalization table on the equity side versus the parallel kind of token strategy, which is usually, oftentimes controlled with a DAO, right? So they don't have full control of it, but how that all interrelates. It's going to be fascinating to see how that all that works.
And so look, some of those tokens are basically equity, and they're providing, not in a situation with a DAO. A DAO is basically an entity that's uncontrolled, that issues tokens. That's really, at least officially, not controlled by anybody. I mean, if the digital asset is a security and basically represents another form of equity in the company, you have debt, crypto, and then you have debt, equity, and then equity in the form of tokens, that should track. You also have some companies just selling tokens, and those are more tokens that are not providing equity. And look, if there are reasons for investors to purchase tokens that are not providing equity, you may feel that this is going to be a level 1 blockchain that's going to provide network advantages, but just for yourself and your investors, know what you're buying. If you mean to be buying something that represents equity, I mean, don't be bashful to ask the question, is your investment thesis that this is equity in the company, or is your investment thesis that this is some other form of token, which may be much more valuable because maybe the payment token of the world? There are reasons, as Abi was saying, to invest in both of those. But if you're planning to get an equity stream of the company, just make sure that that's what you're getting. And if you're selling something, even if you're selling it abroad and exempt from the U.S. securities laws, as a lawyer, just be clear with what you're selling. There are plenty of people who want to buy tokens, and there are plenty of people who want to buy equities. just don't try to sell. Don't try to sell one as the other.
But Steve, because this is one thing that I've been wrestling with, and I think that we touched a little bit on the other day that we were discussing, and to Marty's point, that when you have the equity behind the token, right, after you take it to a decentralized market, or say you put it on an exchange, you take it out of the exchange, you put it in your wallet, you do peer-to-peer trading. Now the invisible hand comes to play, and somebody that wants to have an asset-backed token with US denominated property will pay 3 times the value of that actual equity on the balance sheet of the asset, because they just want to be in dollars, or they want to have something in dollars. So how does these merge one with the other? Because that ends up being a whole AML compliance issue, and the dislocation between the real value of the asset and the token's value. Say, going back to your Aspen property, it trades at 1.02 or whatever. It could trade at 3 if somebody in a country outside the United States wants to hold a piece of property in Aspen that is backed by US dollars.
I mean, look, there's a few different parts of the question. Look, I believe if something is supposed to be equity, it will eventually, at some point, revert to equity-like values. Real estate is its own world, and people are willing to pay extra for real estate. I mean, I think the prestige factor with these tokens have not traded as high as people expected. I mean, let's also remember, I don't need to tell that to people in this here. I mean, stocks are generally sold, not bought. There are a huge number of penny stocks worth nothing. Liquidity is really important, but the role of people selling and the role of people managing is really important part of the equity in real estate markets and every other market. And just putting something on a platform does not create liquidity. I mean, there needs to be a level of market making in general. I mean, maybe that will change in a tokenized world and people will have information, though it could also be the other way around, as there'll be so many opportunities that people won't know what to buy. And yes, when you're dealing with a secondary market, particularly if something is a security, if it's just real estate, it's somewhat safer. There are real KYC AML issues, and that is a way that something can go from just being a securities law violation at worst, which is not a criminal offense, to being something much worse. And how to deal with KYC AML is a big part of this industry, and there are actually intermediaries in this space doing that, which is, somebody had a question of where are the intermediaries that are interesting. We've actually recommended to some of our clients to hire a KYC company to deal with the secondary market, to take it off of them. And one large NFT provider we're working with, which is doing a really interesting launch, have decided to not deal with the secondary market for a while for that reason. So that is a real struggle. I mean, the Aspen property is working with T0, which is probably another intermediary, which is extremely reputable in this space, but that does somewhat limit trading.
Can you guys give other examples of picks and shovels companies, like I don't know, like maybe the guys that are doing mining or things like that?
Yeah, so I mean, I was just saying, mining is a really good proxy in my opinion. Another way to invest in the space. I mean, there are a lot of public miners. I assume people know what mining is, but basically, mining is the sort of consensus mechanism to create, quote unquote, new Bitcoins in the ecosystem, right? So there are a lot of public miners like Hut 8, like Marathon, etc. And that's a good, potentially a safe way to play the market without investing in the coin itself. And miners, it's an interesting way because I see mining as being quite an interesting market that a lot of companies, energy companies, a lot of other people are getting into the whole cryptocurrency mining space. And mining is also interesting because, as far as a year ago, all the mining was done pretty much in China. And China pretty much kicked out all of its Bitcoin miners about a year and 18 months ago, give or take. So all the mining is now coming to America. So I think there are a lot of great opportunities in the mining space, both public and private, as a picks and shovels way to play the crypto.
Basically, for those not familiar with the space at all, with the Bitcoin blockchain and right now Ethereum and most of them, it's what powers the network. I mean, it's one way to, on a very simple level, to think about Bitcoin is, and the whole decentralized world, is that it kind of uses a Wikipedia type crowdsourcing to get the answer, and to reward the computer that kind of comes up with the formula that proves the Bitcoin. They're rewarded a Bitcoin. It is a complicated formula, and as Bitcoin progresses, it gets more complicated. Meaning, for example, 10 years ago, you could have just minted Bitcoins in your computer while you were sleeping on your MacBook. Today, as the formula got much more complicated, and this is called proof of work, you need a supercomputer running off of either stolen electricity or cheap electricity somewhere to justify that. And one of the factors you have to think about is there's a lot of ESG power concerns, contentious area about Bitcoin, and people are thinking of other methods of mining. Possibly you're getting awarded for holding that may change for future at least payment tokens.
We have one quick question from the audience, I guess, because we have to wrap it. So there's a question: is if anyone knows if there's an insurance on NFTs?
Do you mean insurance for it being stolen, or insurance for that you actually own it?
Well, it's not specific. The question is just the insurance.
Well, I mean, look, actually, there's a project that I'm not working on, but I was talking to somebody about who's providing a level of additional insurance. I mean, as a practical advice, if anything in this space is stolen, always file a claim against your insurance company. There is possibility that you may be able to file a claim against an exchange. We represent exchanges. We don't do plaintiff's work, but there's lawyers in the space that do. There may be about the question about the infrastructure. That's exactly right. I mean, look, there is one of the strongest points of Bitcoin, at least, is that Bitcoin itself has never been hacked. There's never been any hack of Bitcoin, but these intermediaries or the off-ramps have had issues, and which is why the more reputable companies may charge you a higher rate, may not sell all of the altcoins. But if you're an institutional investor, you want to be dealing with a stronger counterparty that will either provide a level of guarantee, insurance, as well as reliability. I mean, if you get a better exchange from some offshore exchange, or you have very little protection.
Marty?
What about this crypto that was stolen?
That's
There's Bitcoin was stolen, hundreds of millions of dollars. I think Jay raised that from the audience.
I mean, there have been hacks of exchanges. I mean, and note these exchanges are mostly or almost entirely not taking place on a blockchain. I mean, if you're trading through Coinbase or you're trading through any exchange, those exchanges are taking place on a regular computer server that could be hacked. Bitcoin itself has never been hacked, but yes, exchanges have gotten hacked. There have been other cryptos, and this is beyond the point of this. If you get 51% of users, you can actually hack a blockchain network, which has become an issue with some smaller ones. But you have to be careful who you're trading with and where things are, because there have been, look, sometimes, take it with a grain of salt. I mean, the people who claim they lost these passwords, maybe they really spent it at the casino. But there have definitely been hacks, and particularly for the weaker networks that may not have the great level of data security, because there is no blockchain level protection for most of the off-chain, as we call it, networks and infrastructure.
Yeah, but on the other token, on the other side of that answer, you have the exchange to go and ask for your money or for anything that happened, opposed to when it's totally decentralized, you don't have anybody to go talk to.
Exactly, and I think that's what I mean. I think we have to look at the world as being a debate about centralization, rather fully in favor of full decentralization, because there's a lot of reasons you want a centralized authority. And there's a lot of reasons that centralization in this space, and I think we're going to see, I have no doubt that we're going to be seeing in the next 15, maybe 20 years, a huge innovation in fintech if the world survives. But I don't know how much of that's going to be decentralized. I'm not necessarily convinced the world's going to be decentralized. And investors, I think there's a lot of plays to make in this space, whether or not it's fully decentralized. Because yes, you want someone to go after. And if you're holding your Bitcoin just in a cold wallet, it isn't protected. If you're holding it on an exchange, you have the protection of that exchange, but also the risk of that exchange. So it's all things that you have to think. It's all things that need to be thought through.